how do we make that business plan a 4-goal, 5-minute power play? What are the questions that these business owners need to ask, Cole?
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today we're talking about the Edmonton CPA firm Spurrell & Associates. We're talking about business plan, executive summary, financing required. So your business plan, the executive summary section, and the financing that's required. I have Cole here with me again today. Cole, you saw interesting, happening in the hockey game last night that you were watching.
Yeah, it was crazy. There was like 10 minutes left, and the Sharks were down by 3, and they got a 5-minute penalty or 5-minute power play. They scored 4 goals on that and ended up winning the game in overtime. So pretty exciting playoff hockey.
So they capitalized on their opportunity, right?
Yeah.
They had their shot and they took it. I'm going to tie this one back into this lesson on how to ask for financing. Scoring 4 times on a 5-minute power play. So the quote that we have here is Benjamin Franklin. If you fail to plan, you are planning to fail. And we use that one a lot when we're talking about business planning. And the software manufacturer Palo Alto, they did the survey of business owners who, regarding business planning, and they found that the business owners who completed business plans were 50% more likely to grow their business. And the story that we have here is business owners don't get the right type of financing because they weren't specific in the type of financing that they were asking for. They didn't ask specifically exactly what they needed and what terms they needed in the business plan. They had their shot. They had their 5-minute power play, and they didn't ask. They didn't take any shots.
Blew it.
So, how do we make that business plan a 4-goal, 5-minute power play? What are the questions that these business owners need to ask, Cole?
Well, number one, what is the executive summary?
Executive summary is the most important part of the business plan. That is right at the beginning of the document. It's the summary of the most important factors of the business. The one that the high-level bankers, it might be the only one that they read. Some of the supervisors, and for the business owner, it's the summary of things that you should reflect back on. Even when things are busy, you can use that executive summary without having to go through a 40-page document.
Should you specifically list the desired financing in the executive summary?
Yeah, you need to list not just how much you want, but exactly what form that financing is going to take place, and mortgages and term loans and credit cards, the amounts, and what's the security on that. We need to be ultra specific, not just a level, not just one number. If you just list one number, you're not getting what you want. You have no idea what you're getting, and they quite frankly have no idea what they should give you either. You got to ask specifically about what you want.
Should you differentiate between mortgages, term loans, and line of credit?
Yeah, that is normally the functions that most banks are going to offer. They're going to give a mortgage. That's one type of financing product. Then they're going to give a term loan. That's going to be another financing product. Then they're going to give an operating loan or revolving line of credit. That's going to be a third type. And then even credit cards themselves are going to be a fourth type. And it's usually, most businesses are asking for multiple forms of those types of financing in most deals. They're usually going to need a credit card and something else. A lot of businesses, they need all 4. They got a building and they're going to put equipment in the building. And they need a line of credit to meet payroll, and they need a credit card as well. They need all 4. So we need to be really specific about what types we want, because they all look differently and will have different terms.
Do mortgages normally refer to financing on real estate?
Yeah, so conceptually, mortgages and term loans, they look really similar, but usually when people are talking about a mortgage, it's going to be secured by real estate. The functions of them look very much the same on term loans, but usually when we talk about mortgage, it's secured by a piece of real estate.
Do you need to list the purchase or construction cost with the amount requested?
Yeah, so they don't just want to know how much you want, and they don't just want to see the plan. They want to know specifically how much did it cost to buy that land or building that you just purchased on the mortgage, or how much it's going to cost to construct it. So this thing is going to cost $1 million to construct, and we want the bank to loan 80%, $800,000. Or did this thing cost $500,000 to construct, and we're asking for $600,000 on a mortgage? Well, it's not going to make a lot of sense. It's not going to go over so well at the bank. So let's be really specific on what it costs to purchase it, what it's going to cost to construct it, and what exactly the amount of the mortgage that we're asking for on that product.
Why should you list the interest rate that you're looking for?
You're almost putting them on the spot. You're almost pressuring them. That's your you miss 100% of the shots you never take. I'll take another hockey quote in there. So 100% of the shots you never take. So ask them. My model is based on me getting this interest rate. It's based on me getting prime plus 1%. Me getting prime plus 3%. Whatever that number is, let's make sure that we ask for it. Because they'll know that, okay, if this is charging more interest rate, how close are we? Do we need to be more competitive? Is this the right product? Are we just dealing with the wrong bank altogether? Because they want to give us prime plus 5 and we're looking for prime. We know someone down the street is going to give us prime. Let's not spin our wheels with a bank that's going to give us the wrong rate.
Why do you need to be specific about the amortization period?
The amortization period is so key, and a lot of people think, okay, what's the rate? What's the rate? What's the rate? What's the rate? Well, guess what? If the rate is an extra percentage point, but a 20-year term becomes a 10-year term, you can't make the payments. The term of the payment, you got $1 million and you got to pay it back in 10 years as opposed to $1 million you got to pay back in 20 years. It's drastically different. That can be the skew. It's very often that the deal that we go with or the deal that we recommend our clients to go with is not necessarily the cheapest rate, but it might have the best amortization period. And they might be doing the biggest percentage of the financing and they're getting 20 years on 100%. And someone else is saying, okay, we're going to give you 100%, but 20% of it is over 5 years. And that cash flow in those first 5 years is the tightest. That's when they're trying to grow the business. So the period that they're amortizing the loan over, the period that you're having to pay back that loan over, it's the crux. It's almost always ranked higher on the priority list than the interest. Often we can live with another percentage point on the interest, but we can't even make the numbers work if we have 5 extra years, 5 less years to pay back the loan.
Do separate pieces of equipment or leaseholds often have separate term loans?
Yeah, so sometimes when we're asking the bank for money, we think that it's all just going to come in one big lump sum. But usually how it's going to work is, you're going to have a mortgage on the real estate and maybe a mortgage on the real estate and the shell of the building, for example. And then on the leasehold improvements, it's going to be a completely separate product. And often that product, it might have a different rate and a different amortization period. It's unusual that everything's going to come, lumped together in terms of, and you might have 2 different pieces of equipment, and each piece of equipment you might have, a truck that's $50,000 and the leasehold improvements that's $150,000. They might have different rates and different payback periods. It was really common that significant pieces of equipment are going to be like a separate loan account altogether. They're not just going to be lumped into one giant sum. That's a very realistic possibility. So we want to be really, specific and just be aware that you get those loan documents from the bank and you read the first one. Well, there might be 4 other loans that they're proposing back. That might be the letter that they're sending to you. So we have to be aware that different significant items might have different credit facilities attached to them with different terms.
What are the advantages of lines of credit?
So the line of credit it's almost like the holy grail if you can get the right rate, because line of credit gives you ultimate freedom on the payback period. You're deciding, do I want to just make the interest payments? A lot of times the line of credit we can just make the interest only payments, and we're not locked in to those principal repayments. And often, especially in startup phase or some sort of growth phase where cash is at a premium, it's that line of credit that's the most advantageous because we're not making any principal payments. It's just interest only. And if you can get it, that's fantastic. Now, often those are the hardest facilities to get to. The bank, prefers to lend on hard assets over a term. So they prefer to give you a mortgage on a piece of property or a term loan on a piece of equipment or a leasehold improvement. Line of credit is always a little bit uncertain for the bank, especially in Alberta. They've really tightened up on what they want to give lines of credit for, even in the last 3 or 4 years. But if you can get a line of credit, you might even live with a higher rate for that added flexibility. Remember, you can also pay it back, and then redeploy it if another opportunity arises too. Whereas a term loan, it's paid off and it's done, and you're going back through the process all over again.
Will they also need credit card limits needed to evaluate larger term loans?
Yeah, so sometimes people think that, okay, I can just get my term loan, I'll work out the credit cards later. Just get it all worked out at once, because sometimes that credit card that you absolutely need, you need a $50,000 limit on your credit card because you have a lot of supplies that come through and they bill your credit card. Well, guess what? They might not be able to give you the $1 million on the term loan. They could give you $950 on the term loan, give you $50,000 on the credit card because you're only approved for $1 million. Get those credit card limits ironed out right away. To make sure we got the right total financing, because a lot of people aren't going to be very aggressive to give you credit cards once someone else has first charge, what they call, on the corporation. So you're kind of stuck with getting your credit card sometimes from that bank who has first charge on the corporation. And then you want to be really specific about what you want on the credit card limits, and even more specific, which one of your staff gets that limit. So it might be a $50,000 corporate limit, and the business owner gets 30, and you have an assistant that gets 10, and a frontline worker gets another 10, and that's your 50. Put those names of those people right on the business plan in the financing required section. Just make the process go so much smoother. Those are one of the points where the process starts to drag on, because what the 11th hour, what's the credit card? Who's going to get the credit card limit? How much does it need to be? We know there needs to be a credit card in most business. Let's put it right on there of what we need right to begin with. So I think that's what we have here today, talking about the business plan, executive summary, financing required section. So as always, please leave some comments so we know what you guys would like addressed in future videos. And as always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. Thanks very much.